Here's a company sitting on 318 million Singapore dollars in cash. It owns hotels in the CBDs of Singapore, Sydney, Melbourne, Brisbane, Auckland, and Wellington. It pays a dividend. It generates 35 million Singapore dollars in operating cash flow every single year. And you can buy the whole thing at 58 cents on the dollar. That's Hotel Grand Central. SGX ticker, H18. Today I'm going to walk you through this stock from the ground up. The business, the numbers, the moat, the risks, the valuation, and at the end, my verdict. Let's get into it. Quick agenda for today. 7 things I want to cover with you. 1, the business, how HGC actually makes money. 2, the numbers, 6 years of financials laid out clean. 3, the moat, what protects this business and what doesn't. 4, the opportunity, why this stock trades at a 58% discount to book. 5, the risks, the stuff most channels skip. 6, the valuation, what it's actually worth. And 7, the verdict, would I buy it and on what terms? Let's start with the business. Hotel Grand Central is not a complex business. It does 2 things. First and largest, hotel operations. 14 hotels, 2,906 rooms across Singapore, Australia, New Zealand, Malaysia, and China. This accounts for 92% of revenue, or 134 million Singapore dollars in FY 2025. The breakdown within hotels. About 75% is room revenue, 22% is food and beverage, and the rest is other ancillary income. Second, rental income. They own commercial buildings in New Zealand. Fonterra House and Jacksonstone House in Wellington. This is bond-like income. 11 million Singapore dollars a year, stable, but as we'll discuss, the underlying property values are declining. The key thing I want you to understand about this company, and this is what makes it interesting, is that HGC owns the land and buildings. It is not a hotel management company. It is not a franchise. These are fully owned assets sitting on the balance sheet at over $1 billion. You cannot replicate that portfolio at anywhere near today's market price. That's the setup. Here's where the money comes from geographically. Australia is the dominant market. 85.6 million Singapore dollars, or 63.8% of hotel revenue. Singapore is second at 21%. New Zealand at 14.5%. Malaysia and China together are less than 1%. This geographic mix matters for 2 reasons. First, Australia is where the growth has been. Second, and this is a risk we'll come back to, virtually all of that Australian revenue is in Australian dollars. And with the SGD strengthening against AUD in recent years, every dollar earned in Australia is worth a little less when it lands on the Singapore P&L. Now let's look at 6 years of financials. FY 2020 through FY 2025. Revenue, pre-COVID. This company was doing about 155 million Singapore dollars a year. COVID knocked it hard. Revenue dropped. Then it recovered. FY 2022, FY 2023, FY 2024, FY 2025. By FY 2025, revenue is 145.6 million Singapore dollars. Almost back to where it was. Now look at the EPS chart. And this is where most investors get confused. FY 2020, 5 cents EPS. FY 2021, 2 cents. FY 2022, break even. FY 2023, 2 cents. FY 2024, negative 2 cents. FY 2025, negative 4 cents. 2 consecutive years of reported net losses. The stock gets dumped. People say the company is losing money. But here's the thing. Those losses are almost entirely driven by non-cash property revaluations. In FY 2025, HGC wrote down its Auckland commercial properties by 36.3 million Singapore dollars. In FY 2024, there were 12.4 million Singapore dollars in New Zealand fair value losses, plus a one-off 16 million Singapore dollar tax hit because the New Zealand government changed the rules on building depreciation. Strip those out. Look at operating cash flow. FY 2025, positive 35 million Singapore dollars. FY 2024, positive 38 million Singapore dollars. The cash machine has not stopped running, not for a single year. even through COVID, even through 2 years of reported net losses. That's the number that matters. Let's look at the balance sheet, because this is where the real story is. Cash and deposits, 318 million Singapore dollars. That's 49% of the entire market cap, sitting in cash and fixed deposits. Total debt, 63 million Singapore dollars. That's it. Net gearing is effectively zero. Net cash position, 255 million Singapore dollars. NAV per share, 1 Singapore dollar and 67 cents. Stock price, 70 cents. Let me put that 318 million Singapore dollars in cash in context. In FY 2025, that cash pile generated 9.1 million Singapore dollars in interest income alone, almost as much profit as the entire Singapore hotel segment. They are getting paid to wait. This is a fortress balance sheet. When competitors are struggling with high debt costs, HGC has no debt to service and is collecting interest on nearly 320 million Singapore dollars. What protects this business from competition? Let me be direct about this. It's a mixed picture. Strong location and real estate. HGC owns freehold CBD land in Australia, New Zealand, and Singapore. You cannot replicate this at anywhere near book value. That is a genuine barrier to entry. Nobody is going to build a competing hotel on the same block of land in Melbourne CBD because that land does not exist. Strong, the balance sheet itself. 255 million Singapore dollar net cash. The ability to survive and acquire assets during a downturn is a competitive advantage. Weaker operators struggle. HGC outlasts them. Weak brand. Hotel Grand Chancellor. And they also operate under some other brands. It's not Marriott. It's not Hilton. No global loyalty program. No brand premium. No pricing power above the market. They compete on location and value, not brand. None. OTA dependency. Booking.com and Expedia charge 15 to 25% commission. HGC has no proprietary direct booking channel to speak of. They are price takers on distribution. None. Labor cost moat. Staff costs have risen from 29% of revenue in FY 2019 to 36% in FY 2025. 7 years of steady margin erosion. No disclosed plan to fix it. So, a real estate moat, a cash moat. Operationally, a work in progress. Now, let's talk about why this is on my radar. The 58% discount to book value. NAV per share is 1 Singapore dollar and 67 cents. The stock trades at 70 cents. You're paying 42 cents for every dollar of net asset value. Why does this discount exist? 3 reasons. 1. Family control. The Tan family owns 65% of the company. There are no buybacks. There are minimal capital returns to minority shareholders. You cannot force a liquidation or strategic review. If you're a minority shareholder, you are along for the ride. 2. The New Zealand write-downs. 41 million Singapore dollars in fair value losses over 5 years on the Wellington commercial properties. This flows through the P&L and creates those headline net losses we just talked about. Retail investors see the loss. They sell. Price goes down. 3. Zero analyst coverage. HGC is a micro-cap by global standards. No institutional coverage. No research reports. Out of sight, out of mind for fund managers. The market is not paying attention. Those 3 things together create the discount. The question is whether they justify it. Okay, let's be honest about the risks. This is the part most channels skip. I'm not going to skip it. High severity. NZ investment property decline. 41 million Singapore dollars in fair value losses over 5 years on the Wellington commercial buildings. The Wellington office market is structurally weak. Fonterra House and Jackson House are declining assets. There's no disclosed exit plan. This is an ongoing drag. High severity, family control, and capital allocation. The Tan family has 65% ownership. Despite trading at a 58% discount to NAV, there are 0 buybacks. In a loss year, directors' fees rose 75%. Minority shareholders have no voice. This is the single biggest risk I see. The discount could persist indefinitely if the family has no intention of unlocking it. Medium, the accounting noise hides real earnings. 2 consecutive net losses driven by non-cash items. This is confusing. Most retail investors won't dig into the cash flow statement. That mispricing could be structural. Medium, labor cost creep. 29% to 36% of revenue over 6 years. If this continues, operating leverage won't materialize even as revenue recovers. Medium, FX headwind is structural. 63% of hotel revenue is in AUD. SGD has strengthened. This is not going away. I need to spend 1 minute on this because it's what confuses people the most. Under Singapore accounting rules, SFRS I, when an investment property declines in value, that loss goes straight to the profit and loss account as an expense. So when the Auckland properties are written down 36.3 million Singapore dollars in FI 2025, that shows up as a 36.3 million Singapore dollar expense in the P&L. The net result, a reported net loss of 27.5 million Singapore dollars. But no cash left the building. The operating cash flow, the actual money generated from running hotels and collecting rent, was positive 35 million Singapore dollars. This is an accounting entry. It does not mean the business is broken. It means a portfolio of New Zealand buildings is worth less than it was last year, which is true and is a real concern. But it is completely separate from the operating performance. Always read the cash flow statement. Always. 3 ways to value this company. 3 methods that all tell a similar story. Method 1, owner earnings DCF. I strip out all non-cash property items and normalize earnings to 27.7 million Singapore dollars per year at a 9.5% discount rate, which is fair for a small, illiquid SGX stock with 2% terminal growth. And adding back the net cash position, I get a base case intrinsic value of 1 Singapore dollar and 44 cents per share. Bear case with lower growth assumptions, 1 Singapore dollar and 27 cents. Method 2, NAV based. Book NAV is 1 Singapore dollar and 67 cents. Apply a 10% haircut for NZ commercial property uncertainty and ongoing FX risk. You get 1 Singapore dollar and 50 cents base, 1 Singapore dollar and 34 cents bear. Method 3, EV/EBITDA comps. HGC's current EV/EBITDA is 6.9x. Peer median for hotel companies is around 12x. Even using conservative 10x, the lowest end of any peer, the implied equity value is 86 cents per share. Blended fair value across all 3 methods, approximately 1 Singapore dollar and 34 cents per share. At 70 cents, the margin of safety is 47.8%. That is a significant discount for a business with 255 million Singapore dollar net cash, freehold properties, and stable operating cash flow. Here's the question that I think is most interesting. At 70 cents per share, strip out the 0.345 Singapore dollars in net cash per share. The market is valuing the entire operating business. 14 hotels, 2,906 rooms, 145 million Singapore dollars in revenue, at just 0.355 Singapore dollars per share. At a 9.5% discount rate, 0.355 Singapore dollars per share implies the business earns approximately 19.7 million Singapore dollars per year forever. But current owner earnings are 27.7 million Singapore dollars per year. The market is pricing in a permanent 30% impairment of earning power, not a temporary COVID dip. Permanent. I disagree with that assessment. The business is not broken. It is going through a period of accounting noise and property write-downs that will eventually stabilize. If you think the business merely stays the same as it is today, no growth required. The stock is materially mispriced. For things I'm watching that could close the discount, Catalyst 1, Auckland Convention Center, open February 2026, directly opposite HGC's new 191-room Auckland hotel. Drives conference bookings and hotel occupancy. This is a near-term positive that's already playing out. Catalyst 2, share buyback announcement. This is rated very high by me. At a 58% NAV discount, even a 3% buyback mandate would re-rate the stock 20 to 30%. This is the single biggest catalyst that could close the gap. I am watching every company announcement for this. Catalyst 3, NZ fair value losses slow or stop. 3 years of 7 to 12 million Singapore dollars annual write-downs. If Wellington commercial property stabilizes, 40 million Singapore dollars of P&L noise disappears. Reported EPS goes from negative to positive. Retail investors re-engage. Catalyst 4, AUD/NZD recovery versus SGD. Every 5% recovery in AUD/SGD adds approximately 4 million Singapore dollars to reported revenue. Structural, macro-driven, but high impact if it turns. Here's my base case EPS forecast for FI 2026 through FI 2030. FI 2025 actual, negative 4 cents. That's a reported figure. All the revaluations included. FI 2026 estimate, about 2 cents. Auckland Hotel ramps up. Australia continues to recover. NZ write-downs shrink but don't disappear. FI 2027, 3 cents. FI 2028, 3 cents. FI 2029, 3 cents. FI 2030, 3.25 cents. My assumptions: revenue growing at 3.5% per year from Australian recovery and the new Auckland property. Staff costs stabilizing at around 36% of revenue. Interest income declining from 9.1 million Singapore dollar today to around 6 million Singapore dollars by FI 2030 as rates fall. NZ write-downs fading from 12 million Singapore dollars per year to near zero by FI 2029-30. At FI 2030 adjusted EPS of 3.25 cents and today's price of 70 cents. That a forward PE of just 21.5 times on normalized earnings. Very cheap if the recovery delivers. Quick competitors check. Where does HGC sit versus global hotel sector peers? EV/EBITDA. HGC at 6.9x. Mandarin Oriental. N/M because they're loss-making. CDL Hospitality Trust at 14x. Event Hospitality in Australia at 11x. Minor International in Thailand at 12x. Accor in Europe at 14x. HGC at 6.9x versus a peer median of around 12x. Even at the most conservative peer multiple, 10x, implied equity value exceeds today's price by more than 20%. Dividend yield. HGC at 2.1%, slightly below peers that have higher cash returns, but above Mandarin Oriental. The valuation case is clear. On every multiple, this stock looks cheap relative to where comparable hotel businesses trade. So, would I buy Hotel Grand Central at 70 cents? My verdict, pass monitor, half position at 70 cents. Here's my thinking. The bull case is strong. 58% discount to NAV, one of the deepest on SGX. 255 million Singapore dollar net cash gives you permanent downside protection. The Auckland Convention Center is a real near-term catalyst. Operating cash flow is positive every year. EV/EBITDA of 6.9x versus peers at 12x. But the bear case is also real. The family controls 65% and has shown no appetite to return capital. NZ property losses keep eroding NAV. Staff costs are rising faster than revenue. There is no buyback despite massive undervaluation. And SGX liquidity is thin. Building a position takes time. So I'm not going all in. If I am to invest, I will take half a position at 70 cents. I want to see the catalyst materialize before sizing up. 3 things that would make me upgrade to a full position. 1. Any share buyback announcement. 2. Auckland Hotel hitting 70% occupancy or above in the first half of 2026. 3. Price falls below 65 cents, which increases the margin of safety further. That's the HGC Deep Dive. If this was useful, like and subscribe. I do these detailed stock analyses every few weeks for the JC Project Freedom community. Drop a comment below. Do you own HGC or is a family control risk a deal breaker for you? I'd love to hear. This is not financial advice. Everything I share is my own research for educational purposes. Do your own due diligence before making any investment decision. See you in the next one.